To your friends, Don and Gino.
Thank you very much for joining us on the Don and Gino Real Estate Finance Show every Thursday, 12 p.m. to 2 p.m. right here on your hometown station, AM 1220 KHS. Your Santa Clarita resource for financial and personal advice to help guide you to personal financial wellness with great people like Chris Ingram with Infinity Wealth Management joining us here today. He's been on our show multiple times for a reason. Calm, cool, collected, and in the know. Just like you should be. Right, Gino?
Yeah, it's super educational. I mean, I have some concept of what high-yield bonds might be just because of the name, but we really haven't talked about that before, so I'm interested to see how that really should fit into somebody's portfolio and what kind of portfolio someone would need to benefit from that.
Right. And we'd love you to join us here in the vault so you can check out Chris. We got 3 HD cameras with Furman behind him trying to make us look good, but he's got a lot of work ahead of him. And Shannon Foss now running the board. And you can check it all out by going to donandgino.com, clicking listen and chat live, and you can enter the Vault Media Studio right here at Cherry Creek Mortgage. All right, so that being said, Chris, let's jump into high-yield bonds. First, start off with the basics, because I know a lot of shows like to talk big, and then you're like, if I only knew what that means, then I'd have a context of what the heck you're talking about. Let's just start with basics of what a high-yield bond is and why somebody should care.
Okay. Also known as junk bonds.
We've all heard that before.
Yeah, see? So this is a higher yielding bond than what you would get from investment grade bonds, treasuries, or municipals. And the difference...
They're not the ones people are throwing away. That's not why they're calling them junk bonds.
No, you definitely want to hold on to them. A bond, just backtracking even a little bit further, is so I am giving money to a corporation. That corporation is going to sell me a bond, and they're going to pay me interest for borrowing my money over a designated time period, and at the end of that time period, they're going to give me my money back. So I give them $10,000. They're going to agree to pay me 6% a year, and then at the end of, let's call it 10 years, they give me my $10,000 back. That's pretty simple. So higher yielding or a high yield bond, because of the lower credit rating of that company, and in this case, it's the S&P ranks bonds and ratings of companies, and if they're below a triple B rating, they're considered high yield or junk bonds.
So higher risk.
Higher risk. So what you're getting with these lower credit ratings is a company like S&P, they're coming in and basically saying there's a higher chance of default by that company on this bond, and therefore, by you assuming that higher level of risk, that company is willing to pay you a higher interest rate for your investment.
Because they need your money.
They need your money,
Ultimately, a bond is a loan.
Right.
It's a loan to the corporation because they couldn't raise capital any other way. It's a capital raise.
Exactly.
Got it.
Exactly. And on average, typical is somewhere between 150 basis points to 300 basis points over what you would get from like an investment grade corporate bond. So in layman's terms, that's 1.5% to 3% above what you would receive from an investment grade corporate bond. So GE's bond may be paying you 3%. You'll probably get somewhere around 4.5% to 6% on a high yield bond.
Okay, so it could be really interesting. It could definitely. So do you believe that this belongs in people's portfolios so they could pick up a little extra yield here and there by taking a little extra risk?
Pretty much every single client I have, if they have a fixed income allocation or a bond allocation in their portfolio, have some form of high yield in there. So typically, if let's say a client has 40% of their portfolio that is in fixed income, we may have 5 to 10% of that potentially, depending on the client, that would be in high yield, and then the other 35 to 30% would be allocated into investment grade corporate bonds, short-term bonds, international bonds, different things like that.
Yeah, and let's be clear. I mean, it sounds bad when you call them junk bonds, but if it's something that you're willing to take a 4 or 5 or 6% return on, it probably isn't that risky. In the big scheme of things.
It's still a bond, so it's not as risky. And the other thing is a lot of the way to invest, or the most common way to invest in the high yield market, is to purchase a high yield bond mutual fund or a high yield bond exchange traded fund. So now you're investing in this mutual fund, but this mutual fund owns 200 different high yield bonds.
So you're not going to, hey, Guido, I want a high
I
yield
want
bond.
one
Yeah.
and taking a shot on that one company and putting all your eggs in that one basket.
Right.
So if you own 200 companies and a couple of them default, it's not going to kill the overall performance of the portfolio, and you're going to be able to benefit from the higher yields over time.
See, this is why you work for a professional, ladies and gentlemen. Because this is the difference of you trying to figure this stuff out versus someone who is in the know all day long. I mean, Gino, you and I, we watch interest rates all day long. We have a very good, in fact, we just did a video clip on it, how we know where interest rates are going day to day. And we have a crystal ball that we keep on our table because people go, you guys always know ahead of the game what's going on. We're not geniuses, and those who know us can attest to that, especially my friends sitting in the room, Scott and Ron.
There's a lot of head nodding going on.
Why you guys nod your head, bros?
Yeah. You guys can see that live here at donandgino.com. Plenty of head nodding going on with that statement.
But what we are very good at, as is Chris, because he's a true professional, is he knows his numbers. We love numbers, like you. I mean, we absolutely adore numbers. And we watch them on a regular basis. So we watch trends. And the trends actually tell us what's going to happen. We know the risk tolerances. I mean, you look at Japanese candlesticks like we do, which I know you're going, what does that mean? But bottom line, it's a way that we can gauge resistance levels and support levels based on what's happening in the markets. And it tells us where the risk tolerances are well ahead of time. And I'm sure you kind of look at the same things. Am I right?
Definitely, yeah.
Okay, so it's good to go to a professional because they'll guide you in that path. The key thing is not, and Chris, you are very astute to talk about that, saying it's don't make emotional decisions. We see that all the time when people make emotional. I don't know how many times, Gino, have we had somebody who went to try to purchase a home, and for some reason their offer didn't get accepted, and their life is decimated. It's over.
Oh,
We'll
yeah.
never find another home like that again.
And we've told them 100,000 times every time, and it even happens with ourselves. Anybody in our own market. They always find something better.
Always.
Every single time they find something better, they find the thing that was right for them. It's because they were emotional about it. So not a lot of good decisions come when you come from that space. One of the things, we have a few minutes left, I do want to make sure to ask you, you said there was some recent volatility in that high-yield bond market.
Correct.
Tell me a little bit about that and why that might be an indicator of something to come.
Yeah, so what we saw in mid-July was a bit of a sell-off in the high-yield bond market. And a lot of the investors were actually concerned that rising interest rates and the turmoil going on overseas was potentially going to cause a flight to safety. So people would come out of their high-yield bonds and move into more conservative bond allocations. Because of this, investors decided, hey, let's pull our money out of these high-yield bond investments. So in a way, it was a self-fulfilling prophecy. They were concerned that there was going to be a sell-off, so they started selling off, and they created it themselves. And I forget what the actual number is. I think I have it here. So over a 4-week period ending in August 6th, $13 billion came out of the high-yield bond market. So we saw a pretty...
Jeez, that's a lot of money.
Yeah, it's a lot of money. So it's a pretty steep decline rather quickly over a 4-week period. What then happened, and this goes back to what we were talking about before, not being emotional, understanding your risk tolerance, understanding your allocation, understanding your time horizon, is the institutional money and the hedge funds said, thank you very much, and they turned around and they bought the high yield market as that sell-off occurred. So what we've seen is the market rebound from those August 6th around their lows. About half of the sell-off has already been recovered, and a lot of that was due to the institutional money coming back in and taking advantage of that little sell-off there. So if you sold because you were worried or got caught up in that emotional tailspin, you're kicking yourself right now.
Yeah, especially, you think about things like that, and the institutional investors, because they act for large groups and because the decisions are not made by one emotional person, but usually a board of people making a decision, they're much less emotional.
Yes.
Yeah.
All right, let's have some fun on this topic. You're talking about the ebbs and flows and those who can take advantage of things, and I'm jumping totally off theme, but this is a fun topic, penny stocks. Because it's the same kind of concept where you get roped in, and if you've bought a penny stock, and I am one of them who has done it, because you're like, wow, I can buy for this, and if it just goes from 60 cents to $4, I'm going to quadruple, I'm going to make a killing. But there's a little game played with a lot of those. Not all of them.
What was the movie? Wolf of Wall Street. I just
Bingo.
watched.
Yeah, Pump and Dump.
Recently. Yes.
Yeah.
So I'm gonna say maybe about 10 years ago, I had a gentleman call me from New York, and he was from one of those. He was definitely a pump and dump strategy, and I listened to him. Never, bought anything because I could tell just by the way he talked that he was trying to school me in something. So it does happen, though. The pump and dump strategy is find this tiny little penny stock, put my money in it, put their money into it, these companies doing the pump and dump strategy. So they buy into this investment at a very low price in this little tiny company. And then they go out and they tell everybody how great it is.
And how much it just went up already.
They're making up numbers, and it's going to be the next big thing. And so people start buying this penny stock. Well, like you were talking about before with volume, you're not going to move the market with $10,000, but a penny stock, $10,000. I mean, it moves things. So you start getting money into this, and before you know, your penny stock goes up 1,000%. And then what happens to the guys that have been telling you how great this company is? They take their original investment out of that company, and the company starts falling, and then everybody starts bailing out and freaking out. So you see these big spikes in penny stocks, and then this big giant pullback as the money gets pulled out of it. So completely illegal, and that's why if you watch Wolf of Wall Street, it did not turn out well for him. So if anyone's calling you with those types of strategies, you think twice for sure.
Yeah, make sure you reach out to Chris at Affinity Wealth Management. Say, run fast.
Yeah, I mean, I pretty much can you make money in penny stocks? Sure. I don't do them ever.
All right. Always good sound advice from Chris Ingram, Affinity Wealth Management. How can they get a hold of you, buddy?
Couple different ways. You can call me at 661-255-9555, extension 16. You can email me at cingram@nextfinancial.com, or look at our website, which is www.ingramfinancialsolutions.com.
All right. More great stuff to come with Chris Ingram and Don and Gino. We'll be right back.